But now you're starting to see volatility trickle into the U.S. stock market as well. And obviously things like tariffs on, tariffs off, and other kind of geopolitical events are leading to that volatility. But what you're seeing is that retail has convinced themselves they are just going to buy the dip. And as they continue to see markets go down, they buy the dip, and then we get those recoveries. And I think that's why you see institutions sitting on the sidelines and not having as much exposure to U.S. equities as maybe retail has had this year.
Pompliano highlights a growing trend. Wall Street is no longer ignoring crypto. Major financial institutions are now seriously exploring the convergence of blockchain technology and traditional finance. This shift isn't just experimental, it's strategic. From tokenized assets to decentralized settlement systems, big players are actively working to integrate blockchain into their core infrastructure. One of the most notable developments in this space has been the rapid adoption of stablecoins, which offer both speed and stability for cross-border payments and on-chain financial operations. And before that, be the one who says, I was here before 100K. I'm on a mission to hit 100,000 subs before 2025 ends. Help me get there. Subscribe now and drop your thoughts on the market in the comments. Let's grow and win together.
There's a really big kind of shift on Wall Street, which is they are looking to figure out where's the intersection of cryptocurrencies and traditional finance. And obviously, stablecoins, I think, is one area where they've said, hey, not only is this something that the market wants in terms of the free market of users on the internet, but it's also something that we can benefit from ourselves as well. And you hear many of the large banks and financial institutions talking about using stablecoins themselves. So it's something that is touching on crypto, but it's something that they understand and they can use themselves. And so I think maybe a word of caution is that every crypto company that now tries to go public may not get the same welcome. It may be more of a stablecoin story than it is a crypto story. But then there's companies like, Gemini, which are great businesses and seem to have done really well over the years. And so it's really just going to come down to not are you a crypto company or are you not? Are you a good business or not?
So tell us about Gemini's business.
Well, I think with Gemini, one of the things that they've always said is, look, they want to be a regulated U.S. financial institution, right? And so they've run ad campaigns all across the country doing that. They've really, I think, listened to the users and said not only they want to have the right interfaces, they've come out with this crypto credit card that gives crypto rewards back to users, very popular product. And so I think that what you're starting to see here is a meeting of traditional finance and crypto, right? If you look at exchanges, Robinhood is a traditional brokerage exchange. A very fast-growing segment of that is crypto. If you look at Kraken is a crypto exchange that's trying to add U.S. equities. And I think companies like Gemini are saying to themselves, well, what other financial services can we offer to our user base? And this credit card that they came out with is a good example. And I think you'll see all of these exchanges continue to do this in the future. Coming from the Bitcoin world, a 3% move is, just par for the course. Yeah. But look, I do think that we have an entire generation of investors. I call them either self-directed investors or independent investors. Retail, it now owns something like 36 or 38% of U.S. Stock in the market. It's the highest percentage that they've ever owned. These people are used to volatility, and a lot of it comes from the Bitcoin and cryptocurrency world. But now you're starting to see volatility trickle into the U.S. stock market as well. And obviously things like tariffs on, tariffs off, and other kind of geopolitical events are leading to that volatility. But what you're seeing is that retail has convinced themselves they are just going to buy the dip. And as they continue to see markets go down, they buy the dip, and then we get those recoveries. And I think that's why you see institutions sitting on the sidelines and not having as much exposure to U.S. equities as maybe retail has had this year. Bitcoin, I think there's three things that people want Bitcoin to be. They want it to be a store of value, a medium of exchange, and a unit of account. See things priced in Bitcoin eventually. In order to get there, what we are seeing is that Bitcoin is succeeding and the U.S. dollar is succeeding. They're both strengthening together, and it is the weak fiat currencies that are kind of falling at the feet of those two. Now, one of the things that stablecoins have brought to the market is there's a lot of people around the world that say, I would like to use Bitcoin as a savings account. I call it a digital savings account. I would like to spend something that is not going to be worth more in the future. And so I'll use the digital dollar and these dollar stablecoins. And so if you think about today, the average finance user, they have a savings account, they have a checking account, and they have a brokerage account. That's what we're basically seeing recreated in the digital world. You're saving in Bitcoin, you're spending in stablecoins, and then you are going and you're speculating on whatever assets you want in your portfolio. What I think the big question becomes, and I don't have the answer, I don't think anyone does yet, is as we continue to see the destruction of the purchasing power of the U.S. dollar, are we going to see people start to price things in Bitcoin? Now, I don't think that's something that's going to happen in 1, 3, maybe even 5 years, but I do think that there is a growing group of people who say, look, this thing called Bitcoin is ultimately going to be a store of value, as it already is, but it will become a medium of exchange as well. It just needs to get to a point where the world all agrees on what is it worth. And if you think in 2018, the world thought it was worth $3,000 a coin. Today, the world thinks it's worth $105,000 a coin. it's going to continue to go higher, and at some point it will reach some market equilibrium. And then when you see that switch over into, okay, now things are priced in Bitcoin, I think that's kind of the hyper-Bitcoinization that the Bitcoiners are waiting for. But there is a long path to get there, and the sequence right now is, why would I want to spend my Bitcoin if it's going to be worth more in the future? Right? I want to spend the dollars that are going to be worth less in the future.
How many stable coins based on the dollar do we need? And is Ether the best blockchain network to carry it on? Can it be carried on a Bitcoin blockchain? See, I'm telling you, I'm a bit in the woods.
Look, there's a number of different stable coins that have different kind of twists to them. So if you look at Tether, for example, Tether has really said, what we want to do is we want to take the US dollar, which is one of the best product market fit products ever created in human history, and we want to bring it to people in the emerging world. They have something like over 400 million users. I think they're gaining 30 million users per quarter. Just crazy numbers. $13 billion in profit, over $85 million in profit per employee. Amazing business. Circle has said, well, let's go and actually be the U.S. regulated financial institution and try to go get distribution through exchanges like Coinbase and others. So both of them are attacking a market from two different ends, and I think that both will end up having a business. But then you also get a number of stable coins that say, well, what if we take the interest that we're earning from the treasuries that we're holding and we start to return that back to some of the holders? And you get all these different twists, and we'll see what ends up happening.
Pompliano highlights a growing trend. Wall Street is no longer ignoring crypto. Major financial institutions are now seriously exploring the convergence of blockchain technology and traditional finance. This shift isn't just experimental, it's strategic. From tokenized assets to decentralized settlement systems, big players are actively working to integrate blockchain into their core infrastructure. One of the most notable developments in this space has been the rapid adoption of stablecoins, which offer both speed and stability for cross-border payments and on-chain financial operations. Let's dive into James Lavish's insights as well.
Yeah, everybody wants to be MicroStrategy. That's great. Love it. I love that you have companies out there who are buying Bitcoin on their balance sheet or their treasury, and they want to use that. They want to use leverage to buy more. That's great. You've seen Similar Scientific do it. You've got MetaPlanet that's doing it. There's some nuances here that we need to talk through, though, for people to understand. First of all, MicroStrategy is in a class of its own. Okay, Michael Saylor and Shirish, his treasurer, they stumbled. That stumble is not fair. They discovered a way to monetize volatility in their share price. What do I mean by that? I mean that Michael had this, and he'll tell you himself that he had this kind of sleepy, struggling to grow SaaS business. It's fine. It's clipping along. It's doing great. But it was challenging to grow that business, very challenging. And so he was sitting there one day, and Eric Weiss had orange pilled him, and he finally bought some Bitcoin in the treasury of MicroStrategy, and the whole stock kind of perked up, and he bought more and more and more. The next thing you know, MicroStrategy, taking their treasury and turning it into Bitcoin, suddenly had MicroStrategy stock following Bitcoin and being correlated to it. So why is that important? It's important because Bitcoin's super volatile. It's a volatile asset that's rising. So it's rising with volatility, and that's a good thing. Why is that a good thing? Because when Michael first started issuing converts and debt, he had to secure it. He had to secure that debt with assets of the company or with Bitcoin. But he soon discovered that when he was issuing convertible bonds, right? He had two choices at the beginning. He could just issue more stock, and as he sold stock into the secondary market, he would take that capital, turn around and buy Bitcoin. And the share price would react by going up with the Bitcoin that he bought. But he soon discovered that the more correlated the stock was to Bitcoin, the more volatility there was, the more appetite there was for these convertible bonds. And the convertible bonds are bonds that can be converted into common equity. And hedge funds love these things. Why do they love them? Because you've got this bond that can be converted into the common stock. Well, that means that you own this bond. You can short the common stock against it, And in a certain ratio, it's called a delta hedge, the optimal ratio to short against it. And as the stock price goes up and down, you can be shorting more as it goes up and then covering it as it comes down, and then shorting more as it comes up and covering it. But you're hedged, you own this bond, and you're just short some of it through common equity, that delta optimal hedge. And you could trade around it, make money as it trades. As that stock is really volatile, you can trade around it and make money on it. That's number one. The second thing is, because it's volatile, it's a rising asset that's volatile, then this conversion price on this bond may be, so if MicroStrategy today is trading at $337 or $397, sorry, then, some of these bonds are convertible way down below that, right? And so now these convertible bond owners are way in the money and have made way more money they would have on just an interest rate on this bond, because they were able to convert it and they have the optionality to the upside. It's like an option that doesn't expire for a very long time. And so until those bonds can be called. So the bond buyers, they suddenly said, no, don't give us an interest rate. We don't care about the interest rate. Give us a good conversion price. And then that conversion price will calculate out what that's worth because of the volatility of the stock and what we need on that. And then we'll buy your bond and we'll loan you money for free. So we'll give you the money for free. We'll buy the bond, and then we'll delta hedge around it and play around it. And then hopefully we'll get into the money and we'll convert into common stock. We'll make a whole bunch of money on the back end. And on the other side, Michael's taking that capital. He's turning around and buying Bitcoin with it. And it's accretive to his balance sheet.
James Lavish and Anthony Pompliano's insights reveal a financial landscape undergoing rapid transformation. Stablecoins are emerging as the key bridge between crypto and traditional banking, offering a reliable medium for digital transactions. At the same time, companies like Gemini are showing that regulatory compliance and user-friendly products can coexist, and even drive mass adoption. Meanwhile, retail investors continue to reshape market dynamics, embracing volatility and innovation in ways that many institutions still approach cautiously. The story doesn't end here. Tap this next video to keep going.